Okay, so right now I want to talk about something that is actually pretty important, which is what areas to trade. A lot of traders get this wrong because they just wait too long or they don't wait at all. And so in both of those cases, they get absolutely demolished by the market because you can either trade too early or you can trade too late. And a lot of traders, when they are too conservative, they trade too late. And when they are too aggressive, they trade too early. So one of the important things for you to understand is there's always a balance in where you should be taking trades on, right? And so that's kind of what I want to talk about in this video. I made basically a whole, I've thought about this so long, and it took me some time to actually put it into words. It took me some time, but it was after I started teaching that this started happening, that I started putting everything into words. But I want to talk about where to trade from, what the high value areas are, and how you can understand these high value areas, right? So let's go onto the Miro board, which, by the way, you can always get all of them in the first link. So one of the things that is important to understand is that usually when we are trading, we always have a target. This is a bullish bias. You always have a high that is a target and a low that's supposed to be the low of the range, right? That's what you expect it to be. And then you have the bottom on a bearish trend. Usually you have a high, which is where you expect the market to react from, and you have a low that is supposed to be the target, right? That's usually how it goes, because if you think that if you are bullish, then what is going to happen is you believe the market is going to go from this higher time frame PD array, for example, a fair value gap, and it's going to reach a previous high, right? This swing high. So you would expect the market to go from here to here. Now, how do you know when it's too late for you to trade, and how do you know when it's still okay for you to trade? Well, this is where the 33% and 66% fib come into play. Now, don't overthink the Fibonacci's way too much. It's something that you will understand as time goes, and you won't need the fib, but this is always going to be a good rule of thumb, right? You always want to trade in thirds. This is going to be the highest probability area to long from. So in this case, it's going to be the fair value gap, a higher time frame fair value gap. This is never a 15-minute fair value gap. It's normally going to be a 4-hour fair value gap, 4-hour order block, 1-hour fair value gap, 1-hour order block. And then the extreme is going to be at the high, at the actual target, right? And this is going to give you the three areas in which you want to be trading from. You have the A, B, and C area. The same thing on the lows. And we will see an example of that in play right here, where we had a trade that I personally entered on, and we have the market, the lowest probability market. And as you can see, the market actually did not reach the final target until the next day. And that is one of the risks of the red area, the C area. So let's see, the A area. This is the first third of the range, right? This is the first third of the range. You have it right here. This is where you have the best risk to reward. The problem with having the best risk to reward is that the risk is that you can mistime the low, which means that this can create one more low before it starts moving to the upside, in which then this ratio would completely change, right? Because the extreme of the A area would be down here. And then you also have the highest probability of reversals to happen, because again, if you have a really good higher time frame PD array and you have a very clear bias, we've talked about all of these things. If you have a clear higher time frame PD array and you have a clear bias, you should be able to understand where you believe the market low is. And then once you see the confirmation, right, once you see this market shift, that's when you plot on the fib, because that's when you know where the low and where the target is. So you need to see the market shift. You need to see that the market is in fact moving in your direction for you to be able to point out what the low and what the target is, right? So that is for the first third of the range. Again, you're going to have the best risk to reward, but the only risk is that we could have one more low before we move to the target. But it's also going to give you the highest probability reversals in that area, because again, if you choose the right high time frame PD array. Then we have the B area. So this is the second third of the range. This is good risk to reward. You have some risk of getting manipulated, but a good stop loss, usually below the low, will solve that. Because listen, you know, it's one thing is extremely important for me to tell you. I'm going to make you a profitable trader. This bootcamp can make you a profitable trader, right? This bootcamp can easily make you a profitable trader. But what you will have to understand is that I'm not going to tell you how you are going to have a 1 to 10 risk to reward. That is not going to happen because everyone that tells you and teaches you that is unprofitable. So I'm not going to tell you how to have a 1 to 10 risk to reward. That is not realistic and you will remain unprofitable if you keep looking for the high risk to reward. We've talked about this in the trading trifecta. If you want the high risk to reward, expect the low strike rate and expect the low trade frequency if you want the higher strike rate, right? If you want the high strike rate with a 1 to 5, expect to have one trade a week. Expect to have one trade a month. Not even a trade a week. If you want a high risk to reward and you want a high strike rate, have fun with only one trade a month. Have fun. Right? I'm not going to tell you this. I'm not going to give you a strategy that has a high risk to reward. And the reason for that is because you're going to have an extremely low strike rate. Extremely low. And the reason I'm going into this is because I say some manipulation risk, but a good stop loss usually solves that. A good stop loss usually below the low solves that. What I mean is that a lot of traders, what they do is they get into this area right here. And what they want is they want a risk to reward along like this. Like this is the risk. And this is the reward. Right? That for some of you, for some reason would already be, such low risk to reward. This is not worth it. Oh, really? If this would not be worth it. This is like a 1 to 3. First of all, a 1 to 3 is insane. But what I want to explain is that this is going to be the best risk to reward. That's why it's the A area. It's going to be a reversal. But what are you sacrificing on? Sometimes you are not going to time the low well. And you'll have to enter again. Right? But that's fine. What I want you to understand is that once you are in the B area, you are not going to have as large of a reward. But meaning you're not going to have the highest risk reward. Maybe you have a 1 to 2 or a 1 to 1.5, which are amazing risk to rewards. But you're going to have a higher strike rate because you're waiting already for the market to show you multiple times that the market is moving in your direction. So this is a 1 to 1.5. Funnily enough, that was exactly the trade that I took recently, right? But I always have safe stops. I don't put my stop loss here because, oh no, I want to have this high risk to reward. No, you need to understand, if you want the high risk to reward, expect to be manipulated. And you will, right? And if you're watching this, most likely you are not happy with your trading results. Maybe what you're doing right now is not working. So accept the lower risk rewards, accept the 1 to 1, accept the 1 to 2, accept the 1 to 1.5. Those are amazing risks to rewards. Amazing, right? So again, I went off on the tangent right there. So great probability continuation entries happen in this area, which is actually what happened right there. Then we have the third, which is the C area. Third of the range. Bad risk to reward, high risk of getting manipulated because you're going to get late into the move. Because again, if you want a good risk to reward, you will have to have a tiny stop. If you have a tiny stop, what is going to happen? You are going to be manipulated so many times, especially because in these extremes, usually this is when you have like the order blocks before the high, right? So this is usually where the market moves up, moves a little bit lower, maybe comes back to the B area and only then goes to your target, right? Let me quickly remove all of this. So here you have lower risk to rewards because again, and now I need it all back. Am I even able to? No. Okay. Why? Because let's say you put your entry here. This is your reward. And if you want to have a safe stop, you need to have it at least down here. So all of a sudden, you're getting a 0.2 risk to reward. That is not worth it, okay? Yes, the same person that is telling you to focus on small risk to reward also is telling you anything below 0.7 is low, okay? Just keep that in mind. But that is basically the C area. So the C area is where you are not going to have good risk to reward. You have high risks of being manipulated, and we will see that as an example right here where the market did not reach the target. Why? Because the market came towards this extreme right here. So we'll put this to the left, to the right, sorry. The market came all the way up here, moved all the way down, and then moved to the upside. That's what I'm mentioning. For example, right here, let's put a fib right here. You'll be able to understand. Notice how you would have been fine if your stop loss was here below the low. You would have been fine if you would have taken trades here. But anyone that took a trade right here, very likely that did not have a large enough stop, took a loss. That's what I mean, right? So that's what you have to be careful of when it comes to areas. So if you want to understand what areas you should be trading, you need to, I think the rule of thirds is the best, right? This is what is going to give you the best, highest probability areas to trade from. And I use this as a rule of thumb quite a lot. So it's important for you to understand that if you understand what areas you are trading from, which is what we are explaining right here, the higher the probability of you entering in profitable trades and avoiding losing trades. Because again, well, I am not saying that this high is not going to get reached at this high. I'm saying that there's a possibility that the market comes all the way lower, like sweeps the low and still goes to the upside. And then what? Are you going to have your stop loss all the way down here? Like that, you don't even have a 1-to-1. And that's what I want you to warn you about. The C areas, just be like, hey, well, unfortunately that the market has gone without me. Right? Unfortunately, the market went without me. There's nothing I can do besides wait for the next one. Right? That's what you have to do. That's what I personally do. So those are the areas broken down for you. Again, A area is going to be the first third of the range, best risk to reward, and the risk is that we can mistime the low. So yes, you're having a higher risk to reward, but you're not going to have as high of a strike rate as waiting for continuation entries, which I will show you. And the highest probability reversals happen in this area. Then the B, second third of the range, good risk to reward, some manipulation risk, but a good stop loss usually below the low solves that. Great probability continuation entries happen in this area. In the third, you don't have a good risk to reward, you have a high risk of getting manipulated, and you are going to be late into the move. Now, let's break down this trade because it explains it extremely well. If you check on the daily, now, you know what's funny? I had a student today, I just got off of a Q&A, and a student today asked, well, if that is the case, then how come you don't do something like this with a fib? Why don't you do something like this with a fib, and all of a sudden you know that you shouldn't be trading where you were trading? Because we are day traders. We are taking advantage of 20 pip ranges. And so when I think about the daily, I think about how likely is it that we are going to reach the high. And in my mind, I was like, okay, very likely that we are going to reach the high. And so if we have a little bit of a pullback, meaning power of 3, and then reach the high, that's still a 54 pip move. With the 20 pip stop, I still have a 1-to-2, right? So with that being said, what did I wait for on this trade? Well, I waited for the market to move to the downside, give us some sort of manipulation, which happened here, and then start moving to the upside. So at this point, look, notice where we were. So let me go back. We were at a 4-hour fair value gap. You can include the inverted fair value gap right here, but I don't think there's a really high need of including this fair value gap. We can just think about the 4-hour fair value gap. Okay, let's get it. So 4-hour fair value gap right here. And then what did I wait for? I waited for the confirmation of the market shift that this is now the low. So for example, here, this was already during the time to trade. Boom. Now I'm able to point out a low and point out the target, right? So we have the higher time frame level, which is this higher time frame level. Reversal, okay, now I know the low, now I know the target. I am able to set my fib. So I set my fib and I explain that to me, right now, sorry, that's me, right now, I have to trade anywhere here. I would even say to the 50%, but sometimes you still have a good risk to reward. In this case, you didn't, but whatever. So the market moves lower, moves higher, moves lower, confirms, and notice where my entry was. My entry was actually, don't worry about the fib levels. My entry was at the order block right here, which actually was in an A area, but my entry was a little bit above. So again, I'm okay with executing on this trade because we are in a high probability area, very likely that we are going to go for the highs, and the risk to reward is there, right? Notice where my stop loss is. My stop loss isn't right here. My stop loss is all the way back down, 19 pips at the low, right? I'm not trying to call for an extreme market reversal. The market can prove me wrong for some time and then still play out. Because for me now, this big move, this start of this move until here is a high probability area for me to execute on. Now, some of you might say, well, Kimmel, but let's say I didn't execute on that trade. Well, I had students that executed once the 1 hour switched bullish. So once the 1 hour switched bullish, notice where you are executing on. You're executing in the yellow area. So B area. So still stop loss below the low, 24 pips to the high, which is not going to be at the high. To the high, you still have a 1 to 1.2. And again, let me preface this once again. Some of you are going to say 1 to 1.2 is not good. Well, really? So how have your results been lately? Right? That's what you got to think about. How have your results been lately? If they are not as you would want them to be, then how come you are judging something like a 1 to 2, which is consistently profitable, right? This month, I'm recording this January 2025. This month, I'm up 3R in 4 trades. How many of you were profitable in January? Maybe you took 20 trades and you are -3. Maybe you took 20 trades and you are +5. Who do you think had the better headache to reward? I took 4 trades and I'm 3R up. You took 20 trades and you are 5R up. I would, every single time, I would switch into my strategy again. Because you might have a little bit less trades, but you have way less headache. And by the way, this was a month with quite few trades. Like with Trump coming into office and so on, it wasn't the easiest month to trade. So again, and I still took 2 wins, 1 break even, and 1 loss. But this to say that I don't only think about the highest risk reward. I think about, okay, how can I enter in high probability trades? How can I consistently have good risk rewards? And my students, for example, right here, boom, entry, went to TP in less than an hour, in less than 2 hours, right? Is that not absolutely amazing? It is, right? Because the other thing you need to keep in mind is that at the C area, your TP should not be at the extreme of that C area. Your TP should be, for example, at 50% of that area or 75%, because this is where you can expect the bigger pullbacks, which is exactly what happened, right? So for example, right here, same thing. So we had higher time frame PD array getting tapped. This is still the 4-hour fair value gap. We have the market shift. So now you put the fib, final target, boom. Where is the good entry right here? Fair value gap and order block. So notice how right there, our entries are at the fair value gap, boom, stop loss below the low, and the target is a 1 to 1.1. It's not the best target, I give you that, but it's consistent. In 2 days, you would have entered in 2 winning trades and you would be up 2.5R. Would that not be amazing? If every single week you would be able to pull out 1.5R consistently, would that not be amazing? Of course it would, right? It would be amazing. So that's what I mean with knowing when to trade and when not to trade. Personally, this has been the best framework for me as a trader. This has been the framework that has completely changed my trading, because a lot of the times I would see the market moving a little bit and I thought, okay, boom, I have no more risk to reward. Now I'm going to get manipulated. Not really. You can still have a good risk to reward. So if you want the settings for this, you can have it right here. But yeah, it's very, very simple. It's simple to understand, and it's simple to apply. Once you are at a higher time frame key level that you expect a reaction from, in line with the daily bias, you wait for the market shift, and then you mark out the 3 areas, A, B, and C. You know that you have to execute between A and B. And then, by the way, if we quickly go back to this one, so if we quickly go back to this area, so let's say you would have missed my trade. So let me remove the 1 hour trade. So let's say you would miss my trade right here. What you could do is you can go to the 5 minute and notice how the market moves up, move lower. Okay, confirmation. If you don't enter here, which is where I entered, you can enter here, right there, right? If you don't enter there, you can enter here. If you don't enter there, you can enter here. But again, you're already reducing your risk to reward quite a bit. But let's say you enter right there. Stop loss doesn't really go below the low, but you still have almost a 1-to-1 towards the high. This could be the ones where you take a break even, right? But it's for you to understand that there's a lot of possibilities for entry between the first market shift and the final target, right? The most important thing for you to do is understand, okay, if you're entering in B areas, you're not going to have the stop loss below the low. That's why they're not the best probability trades. That's why it's called a B area, else it would be an A area. So there's still a risk reward, right? So just don't, if you ever see the market going off towards your target and you're still not in, just understand there's likely still a tiny area that you can take advantage of. So that's really what this video is about. So understanding the high value areas and where you should trade and where you should avoid trading. So with that being said, I hope this was helpful. I will see you tomorrow. And again, we are already starting to put so many things together, right? At this point, you already understand the daily bias. You already understand market structure. You already understand the entries. You already have done all of these things. So now the number one thing you have to do is understand what areas and when to trade and when not to trade. And this is this. Hope you enjoyed. Peace. Hope you enjoyed this lesson. Click right here to watch the next one. And if you are struggling with overtrading, then click right here to check out Trade Blocker. Peace.